When I make my real estate investments, I don't actually look at appreciation because appreciation is not really in my control unless I'm investing money to improve the kitchen and paint and appliances and electric. Then you appreciate, but you had to put in $80,000 to get it to appreciate $100,000, right?
Wake up, it's time to be free. Wake up, was blind, now I see. Wake up, it's time to be me. Wake up, my mind is the key.
Wake up, it's time to be me. Wake up, my mind is the key.
What's up, it's Jullien Gordon with another episode of the Daily Jules, where I drop nuggets of wisdom to help you increase your degrees of freedom. I don't care how many college degrees you have. The only degree that really matters is your degree of freedom. I don't care how much money you make. The only thing that really matters is how you actually make money. So one other way that I make money that I use with some of my business profits that I don't necessarily know how to reinvest into the business towards the end of the year, I actually invest in real estate, right? And real estate is more semi-passive. I'm going to do this work for as long as I possibly can, right? I have no plans to retire early. This is not about quick retirement for me. This is because this is in alignment with my life work. But because I have a family, because I have my wife and my daughter, I need to secure our financial future as well. So what I do is I take some of the profits from my business and I use the, or some of either profits from my business, or you can look at it as what I pay myself from the business, and I invest in real estate. And then I have 3 family in New York and 3 other duplexes, 2 in New Orleans and 1 in Oakland. And so the question that I got this week from somebody was how to know when it's time to let a real estate investment go. So this question can be looked at 2 ways. Let it go is oftentimes referred to when it's going bad, but there's also a time to let it go when it's going good. For me, real estate is a long-term investment. I'm not a flipper. If those of you know me, I'm all about cash flow more so than taking lump sums. And so I'd rather, if you offer me $10,000 today or $1,000 in perpetuity, I'm going to take that $1,000 in perpetuity all the time. Even if you offer me $10,000 today or $500 in perpetuity, I'm probably going to take that $500 guaranteed in perpetuity over the $10,000 lump sum right now, right? So let's talk about let it go from the downside. With me, I don't actually look at letting real estate go on the downside. That's when most people want to let it go because their house is underwater. But real estate markets go up and they go down just like the stock market. And so it's really about holding on to it long enough until it actually goes back up. When I make my real estate investments, I don't actually look at appreciation because appreciation is not really in my control unless I'm investing money to improve the kitchen and paint and appliances and electric. Then you appreciate, but you had to put in $80,000 to get it to appreciate $100,000, right? So that's a lot of cash outward. So when I just look at a raw real estate investment, of course I want to go to a neighborhood that's up and coming, and I want to go to neighborhoods where it's likely to appreciate, but I don't account for appreciation in my investments. The way I look at my real estate investments is what are the potential rents for that particular location, and then what is going to be the more property interest, principal, interest, taxes, and insurance, right? And then property manager and other expenses that I'm going to have to pay, and what is that going to be? And as long as the rents are greater, right, than all of these expenses, then I'm usually a go, right? Because guess what? Even when your multifamily home is underwater from a equity standpoint because it won't sell at what you're actually paying or what you paid for it or the purchase price, even though it's quote unquote underwater, if the cash flow, the rents are greater than all the expenses, then that house is still making you money. And over time, if you look at a 10-year period or a 30-year period of holding, that house that is quote unquote underwater at the moment, it will go back up eventually. Just real estate operates in cycles. But if you're in a short term, you're like, oh, it's underwater, I need to sell it. You're selling at a loss, right? So if your cash flows are there to support you when that particular market goes down, then it's okay. For instance, a lot of people probably had to sell in New Orleans after Katrina because their houses were underwater, literally and financially, right? They had to sell. But at the end of the day, when you look at New Orleans now, that same piece of property that somebody got or sold for $50,000 after a few years after Katrina, you look at the price of that property now and it's probably 3 to 4 times in value. You just have to be willing to hold. So that's how I look at when to let go of property. Now, the property that I'm invested in with my good friend in Oakland, we have an agreement where we said if it appreciates to this much, we're going to take the cash and split it and go, right? If it appreciates to this much. So that's how we've set that up in our agreement, to say if it appreciates, let's say $100,000, $200,000 over what we paid for it, meaning that the market is really peaking, right? Then we say, yeah, we're going to sell it and cash out, right? And then we're going to go, he and I will likely go reinvest in another property somewhere else, because that market is at its peak. You don't just go buy in the peak market. You go find a market that's up and coming, right? So you want to figure out what that number is for you. Before you actually sign off on the deal, what would be your exit number from an appreciation standpoint? But for me, I typically focus on cash flow, and appreciation, if the house does appreciate, is just that's just icing on the cake. If I was getting profit every single month from the monthly cash flows and it happens to appreciate, that's all just gravy. Okay, so this is how I think about my real estate investments. I'm new to the game, even though I'm 4 properties in. I don't consider myself a real estate expert. I could be missing something, but for those of you who are just beginning and just want to get started, this is how I think right now. And if I get new thinking about how to make real estate investments, I will definitely let you know. All right. So this is Jullien Gordon with another episode of the Daily Jules. I hope that this one has blessed you. Go to some open houses this weekend, run some numbers, and see what your market is looking like, or go find a new market that you may be interested in. I will tell you this, that owning from a distance can be a challenge if you don't have the right team on the ground, right team in terms of property manager and contractors. But that's always possible, and as long as you can account for that in your expenses, right? Property managers 7 to 10% of rents, and contractors are going to usually be there for the initial update to the home when you buy it. As long as you have the right team on the ground, I know it's possible because I'm doing it. So with that, wish you the best, and I'll catch you in the next episode. Peace.
I hope these mindsets, metaphors, and methodologies blessed you. If you desire more freedom, go to getfreenow.com to subscribe to the show on iTunes, YouTube, or Facebook, and get 4 of my best courses in the Freedom School for 100% free.